When starting a business, entrepreneurs must decide which of the forms of ownership will best suit their needs and type of business. An advantage of a sole trader is that there are no legal processes or requirements for setting up the business. A disadvantage is that the owner is responsible for providing all the business's capital requirements. An advantage of a partnership is that partners are motivated to work hard as they share profits. However, partnerships dissolve if a partner dies or retires. The advantage of closed corporations is the business is a legal entity and has continuity of existence. However, CCs are taxed the same as companies, which could be higher than personal tax rates. An advantage of a private company is that auditing of financial statements is voluntary. A disadvantage is the costs and formalities associated with forming a private company. Personal liability companies are subject to fewer disclosure and transparency requirements than public companies. However, it is difficult and expensive to establish a PLC when compared to sole proprietorships or partnerships. One advantage of having a public company is that competent and knowledgeable directors can be appointed by shareholders. A disadvantage is that financial statements must be audited, which increases the operational costs of public companies. With state-owned companies, an advantage is that they create job opportunities for all skill levels. A disadvantage is that they often rely on the government for subsidies and bailouts or financial relief. An advantage of non-profit companies is that the NPC's assets belong to the company and not its members. A disadvantage is that creating an NPC takes a lot of time, effort, and money. Let's revise the benefits of establishing a company over other forms of ownership. Regarding legal status and liability, shareholders' private assets are protected as they have limited liability. In terms of profit sharing, shareholders share in the profits of the company through payment of dividends. With regards to ownership and management, the company is managed by a qualified and competent board of directors. Regarding capital and cash flow, companies have long-term growth opportunities due to the possibility of increasing the number of investors and shareholders. In terms of lifespan and continuity, a company has continuity of existence and the business's lifespan often exceeds the lifespan of the owners. Regarding taxation, a company may obtain tax rebates through the company's involvement in social responsibility projects. There are also some challenges of establishing a company. These include having to submit detailed reports to all stakeholders at the end of each financial year, and having to disclose all financial information, which could provide competitors with an unfair competitive advantage. During the formation of companies, certain procedures need to be followed, which include, amongst others, preparing a memorandum of incorporation, opening a bank account, and registering for taxation. A notice of incorporation will also need to be filed to obtain a unique registration number. There are certain legal requirements regarding the name of the company which include, amongst other things, that the company's name must be subject to approval by the Companies and Intellectual Property Commission, be original and may not be misleading, and indicate the type of company. The Memorandum of Incorporation serves as the constitution of the company and stipulates the rights, duties, and responsibilities of shareholders and directors of a company and contains essential information, including the extent of any restriction placed on directors' powers of authority, shareholders and meetings and procedures, the number of shares each incorporator will purchase. The notice of incorporation must be lodged together with the standard form of the MOI and is used to inform the CIPC of the purpose and incorporation of a company. The NOI should include information such as the type of company, its registered address, and the company name. A prospectus is a written invitation to the public to buy shares. It includes information on the company such as assets and liabilities, financial position, and profits and losses. The initial public offer is made when the company issues shares to the public for the first time. A secondary offering is when shareholders, rather than the company itself, offer securities. This is only done after the initial public offer.